So today we'll talk about 3 UK listed micro and small cap dividend stocks. Each is an investment prospect in a different context and one that I found interesting for different reasons. As always, this isn't financial advice, this is just my opinion on what I find interesting. I would really appreciate it if you let me know what you think of these picks down below in the comments. They all have very healthy dividend yields, coming in between 5 and 7%. Why I find these low-cost dividend stocks so appealing is the potential for compounding returns by reinvesting the dividends. Because the individual share price is low, it's quite easy to build up a substantial number of shares over time, and even if the share price and dividend don't raise drastically, your number of shares can quickly multiply, meaning increased dividends down the road. Further to this, being a UK-based investor, I incur 15% tax on US listed dividend distributions. I'm happy to avoid this with these stocks. Even if the share price increases, sending the yield down, buying now means the yield is secured at the earlier buying price, retaining your effective yield, and if the share price drops, you get more shares to buy each time the dividend pays out. I'm sure we all know the power of compounding by now, and whilst of course these choices may not yet turn out to be stocks to hold forever, I think they're definitely worth a closer look, despite the relatively high dividend yields which can often cause concerns. The first stock we'll look at is Next Energy Solar Fund, ticker NESF on the LSE. It's the highest market cap and most established firm of the three, with a dividend yield currently around 7% and a market cap just under £600 million. As of September 2021, they operate 99 different solar assets, with a total installed capacity of almost 900 megawatts. With the majority of these assets being in the UK. They have been increasing this figure year on year since IPO. They aim to offer attractive investment returns via dividends, and they are targeting 7.16 pence per share for the financial year 21-22. Such a high dividend yield obviously raises concerns as to whether it is sustainable. It would be quite ironic for a solar energy fund to go bust due to unsustainable operations. But they have been raising the dividend every year since they were listed, in line with RPI. Current dividend cover currently sits at just over 1. This leaves the dividend looking quite precarious, but the company seems to have its cash flow and debt structured in a way that makes the financials quite predictable, and recent increases in energy prices should keep their cash position looking quite healthy. In terms of share price history, the current price seems quite attractive when compared to its peak pre-COVID. There's always so much doom and gloom when it comes to the markets, but the demand for power is pretty much constant, and with such a high dividend yield I can understand why some would see the benefit of keeping money on this stock. Even if the price just stagnates, you would still be drawing a healthy quarterly dividend. The annualized shareholder return since IPO stands at 6.2%. It's worth noting this graphic is only for half of 2022, and they are on track to beat their 2021 dividend in 2022. The second stock we'll talk about today, and for me the most interesting, is Duke Royalty, who bring the royalty business finance model to European markets. A £50 billion sector in North America that isn't quite so prevalent yet in Europe. Royalty financing is a business model akin to a corporate mortgage. Duke provides cash up front, and the borrower pays back a fixed percentage of its future revenues or profits to Duke. Businesses accessing capital this way can do so without giving up actual shares and diluting their control in the company, preserving their own and any shareholders' equity positions. The advantage for Duke is a predictable form of cash flow from borrowers, when typically they would only see their returns when selling stock, so it's easy to see how this business model can be mutually beneficial. Now, to talk about the company specifically, they are still a relatively new company, listed in the UK on the AIM since mid-2015. They have a market cap of only around £150 million. At present, they have 11 royalty partners, with £140 million deployed since inception. The dividend yield has ranged between 5 and 8% since IPO, paid quarterly, currently yielding just under 6%. Obviously, the biggest risk here is that the companies they are lending to fail and cannot honour their payment obligations to Duke. As mentioned previously, 11 royalty partners doesn't sound like a huge amount, but I think this can actually be interpreted positively. They are obviously careful about who they work with. In fact, we can see that they did have a few problems throughout the pandemic, initially suspending dividend increases whilst assessing the situation. Some of their partners did struggle to meet their obligations, and Duke opted to take equity stake or to allow deferred payments for these firms, whilst investing further capital into some of their investments that were best positioned to take advantage of the situation. They managed to establish 4 new partners in 2021 and are already surpassing pre-pandemic revenue again. They have a defined criteria to help them find the right kinds of organizations to invest in, avoiding some higher risk choices such as startups and biotech firms. Both sectors can be notoriously all or bust, so it's definitely wise to steer clear. In a standard example that they give, the agreement has a 30-year lifespan with an initial annual yield of 13%. This annual yield can rise or fall by a maximum of 6% per year. This gives the agreement a payback period of as little as 6 or 7 years, while securing long-term cash flow beyond that. Companies do have the option to buy the agreement out after 3 years for the initial amount plus a 20% premium. Whilst this does lose long-term cash flow for Duke, it does generate some quick income and allow them to set about redeploying their money. The current share price is approaching levels last seen in early 2020. It took a sharp drop when COVID hit and they dropped the dividend. But as we can see, they've been increasing cash revenue and earnings per share, and they have good levels of liquidity currently to take advantage of any new opportunities that present themselves. Given they are in such a strong position, we may see them start to increase their dividend again this year. And while yes, the best time to buy would have been in that tasty pandemic dip, I think this stock can still provide a solid return to investors in the long term if they can continue along their current path. Our final stock today is Wentworth Resources, ticker WEN on the AIM in London. Their market cap is the smallest of the lot, only £42.5 million presently. They operate in Tanzania, extracting natural gas for domestic consumption. Their daily production levels have reached a good capacity in recent years as Tanzania aims to give more of its population access to electricity. We can see how their business position has developed over recent years with an increase in free cash and going debt-free in 2020. Cash flow is secure, with domestic energy distributors almost fully up to date with their payments despite the COVID situation. Recently, they used some of this excess cash to raise the dividend, roughly 10% over last year's distribution. They have also repurchased some shares in December 2021 with the aim of rectifying an undervalue to their NAV, their net asset value. This helps to ensure that the stock isn't too far undervalued. Even with the dividend increasing and buying back shares, their current cash position stands at $21 million. More than comfortably covers the dividend for a couple of years, not even accounting for future cash flow incomes. They have also spoken of intentions to identify new opportunities beyond their core asset. Their current cash in hand is almost half of their market cap, meaning if they can utilize it, there is potential to increase this through any opportunities. Even if this doesn't happen, they should still be a good stock for income generation, especially as their spending is fixed at a low level, they are debt-free, and demand should remain pretty constant. As always, thank you very much for listening. Subscribe for more content in the future, and let me know down below what you think about these stocks.